But we do, I think this panel is really timely and really interesting because it kind of carries forward what some of the things that Craig was talking about, in the sense that, you know, there do seem to be headwinds looming, and we don't know when. And so we get asked that a lot, you know, sort of when is the next recession? What are the mechanisms we should be looking for? And as Craig was very eloquently pointing out, we don't know. And I was thinking about, I wonder if he feels the same way, but I have a couple daughters that play hockey, and one of them plays at a really high, like the top level, but she's short. And so she asks me, for her birthday, she wanted a growth spurt. For Christmas, she wanted a growth spurt. So she asks me all the time. She goes, when am I going to get taller? And I feel like probably what Craig feels like, you know, kind of saying, anytime, anytime. And she wakes up the next day and she's, I'm not taller. And I go, anytime. So that's probably how a lot of economists feel right now, and how a lot of the folks in the room feel, because you're kind of on pins and needles and you're kind of thinking, you know, how do we do this? And so we started thinking about this at TransUnion. We thought, well, because we do get, when we talk to lenders a lot, we get asked this question. And we thought, you know, maybe let's change the direction of the conversation. And because, again, as Craig so eloquently pointed out, we can't really, it's really, really difficult to kind of pinpoint the exact timing of when this would happen and what it might look like. So instead of focusing all your attention on that, maybe focus your attention on understanding the impact and preparing and having a strategy and a playbook in place. And so we kind of went down that path, and we talked to a lot of banks, a lot of lenders, a lot of folks on the stage, a lot of folks in the room, and we talked, you know, across multiple regions that we work in, U.S. and Hong Kong, South Africa, a lot of other countries, UK, and we got a sense of what are you doing, and how are you preparing for this, and we got a lot of different viewpoints, and we've created sort of this best practice that we believe is sort of a best practices playbook for downturn readiness. And really, we identified a few lenders that are exemplars and that have historically, according to their annual reports, fared materially better coming out of recessions than the rest. And so we went to them and said, what do you do? And so there's a few strategies, and we'll get into it because I want to spend more time with the panel and allow time for any questions. But basically, it was sort of the four pillars. It's not a risk-led initiative. It should be an initiative that's led across the organization. Early warning and monitoring, coordinated effort across the enterprise, balanced mitigation, so it should include front book, back book if you're a lender. And one of the most important ones that we saw very few talking about, but the exemplars did spend a lot of time thinking about, is maybe what's just as important as figuring out what to do during a recession is figuring out what to do as you exit, and sort of that reentry strategy and get that first mover advantage. And so with that, Gary, I was going to ask the panel to introduce themselves, but Gary's already pointed out that we don't have time. So I'll skip the long intros, and we have three leaders of three very excellent lending businesses in Canada and a couple that are global. And we're going to talk a bit of strategy around downturns. So I have Neil from OnDeck, Jason from goeasy, and Kevin from Lenfiied. And I'm going to turn it over to the panel. And so, you know, kind of maybe at a high level, you know, historically, downturn strategies, as I mentioned, are owned and managed by risk, where in a lot of, especially the large banks, it's sort of a risk-led initiative. And like I said, emerging best practice seems to suggest that maybe a broader set of corporate functions should be involved, or there should be a broader strategy in place. And so I wanted to pick each of your brains, and from your experience and from your businesses, what do you feel are the best practices in terms of setting this up and having a strategic approach to downturn readiness? And maybe I can start at that end and go with Kevin and come this way.
Okay, good morning, everybody. Great question, and I think what's interesting to me is, you know, at the end of the day, we're 20 people in the company, and so when we think about who's involved, it's hard not to think that a lot of people are, but there are also a lot of third party and connections that we need to think about, and because we're a lending business, there's a lot of capital moving around, and so I would say that, Matt, there's a need for discussion not only from a risk perspective, but from a funding and therefore third-party funding relationships, you know, with the people that supply the credit, that make sure that they're comfortable with what the thought process is that's going on for the next, you know, 1 or 2 or 3 years. I think it's about trying to respect all the stakeholders that have a view on or an interest in the company's well-being that have to be involved, not just risk.
So I'll build on that. I'd add to that, and I'd say 2 comments. One would be, I like the comment that Matt made about a multidisciplinary approach. I chair our company's credit committee, which meets on a regular basis to assess, monitor, and react, in some cases proactively respond to changes in credits and markets. That committee is chaired by more people that actually don't sit at the risk table than do. It has our chief marketing officer, it has our chief financial officer, it has our chief executive officer, and the purpose behind that is to get varied opinions, because what I, as a, let's call it a traditional risk professional, will always guard against is the bad times. What often a chief marketing officer and even a CFO will bring to the table is identifying or getting us to think a little bit differently about those opportunities for growth. Because sometimes good growth is good growth, and good growth can help bad growth, especially when you're not sure about what the future looks like. The second comment I'll make is in regards to how we at least think about the future, because I would agree with the comments that Craig made earlier. We would agree that we're at the longer end of the cycle. And a good risk manager, never mind a good CEO, will typically tell you that the best way to plan for the future is to make your moves in good times, not in bad times. I think the challenge that traditional risk professionals faced, and I certainly experienced this in 2008 and 2009 when I worked for Citigroup, which obviously was affected by a crisis, is you can never move soon enough. You're always going to lag unless you have a really good understanding of what the leading indicators are. And Craig would tell you, as an economist, there's lots of macroeconomic leading indicators you could look at. But the other thing that we're starting to think about is, well, how do we see those leading indicators manifest itself in the data of the customers that we're looking at? Traditionally, we've relied on information like credit bureau data, which has been a great way in looking at assessing potential risk of a given customer. But that in and of itself can't be our only resource. We have to look at other information points that can give us insight into how our customers are thinking before they start to change their behavior in a material way, so we can get out in front of it. So I would say 2 things to consider. One is take a multidisciplinary approach when it comes to thinking about how to plan for risk, and constantly and vigorously be on the lookout for new and alternative data sources that you can validate that might give you a little bit more of a window on when that leading edge is going to tip, because it will tip before you can react, and as soon as you can figure that out, you'll be a little bit further ahead.
I guess for us the key word is flexibility. Flexibility across all the different work streams, and we really think about it on a work stream basis. And when I say flexibility, it's flexibility with regard to product that you're offering. It's flexibility with regard to your funding sources, so having multiple funding sources. Flexibility with regard to how you're going to deal with collections issues or late payment issues, and have flexible workout for your merchant customers. So it's really across all the different work streams. And in terms of preparedness, there is opportunity. If you look at some of the data that came out of the US after the 2008 financial crisis, it took more than 4 or 5 years for charge-off rates to get back to where they were pre-crisis for the big banks. So nimble players that are non-bank lenders have an ability to take advantage of that opportunity in downturn cycles. So it's being prepared, but also being nimble and being flexible across all the different work streams. And to give a final example of that, you know, it's not just an economic downturn. In Canada, in the last couple of years, we had issues like wildfires at Fort McMurray, or hurricane preparedness and planning in Eastern Canada. Our marketing department, for example, reached out in advance to say to those merchants, hey, can we help you? Do you need a delay in payment or whatever it might be? So really being proactive from a marketing perspective and or an opportunity perspective, aside from, of course, wanting to work with those merchants in areas that are going to be impacted negatively. So being prepared and being flexible, I think, is a key to our business success in being a non-bank, nimble digital lender.
Can we carry on a little bit on that? Because I think it's an interesting point. It's just to note that, I mean, at the end of the day, we still want growth in our businesses. And for the Lenfiied platform, it's only 4 years old and wants growth. And so does one try to manage, kind of to Jason's point of expecting things and being prepared, or does one hope for a little bit of Neil's comment on the flexibility and manage as it comes? In other words, if we're running books of 6-month to 18-month turns, do we still have an ability to manage that when we do hit some trouble? And are we nimble enough to then say, okay, well, this is now what we need to do, versus the prudent preparation, and I respect that wholly, on getting ready. So there's this little bit of challenge in my mind about wanting still to be progressive when you hear from someone like Brian, and it was a fantastic comment, and classically, if he's in the room, well done, but also classically, do we really have an answer where we're going? And so in my mind, it's a little bit of status quo, to sound a little bit risque, in the next little while as we carry on, in the interest of wanting still to be growing, but wanting to be cognizant of understanding what changes might be necessary in credit policy or otherwise, collections, et cetera, manual activities to actually manage things if they do come.
Yeah, I think it's an important point, and I think, you know, when we looked at some of these exemplars across the world that have been able to really react in a downturn, they talk about that growth mindset and sort of not just circling the wagons and just focusing on it's all, you know, cut your cutoff scores lower, your, you know, all credit limit decrease, stop lending. It's not, you know, freeze the business. It's how do we maneuver through it. And I think the companies that we've seen that tend to be the ones that are able to kind of gain share in some senses through this are the ones that are thinking of those things, and to your point, Jason, are thinking even about their customers and saying, you know, they're in the same boat we're in. Like, you know, whether you're a consumer lender or a B2B lender, if there is a recession, the folks you're lending to are in that recession. And so, you know, what can we do to help them? And it's a great opportunity from a customer experience perspective, and we've seen that where I think, Jason, you had a couple of really good examples around what happened at the wildfires. We did a study in the US last year that showed that there's actually, if you can figure it out within your risk tolerance, there's actually a significant benefit to extend more credit to people that are actually going through a hard time if you can identify those that are actually just struggling versus really bad. Because if you can get them through that patch and not just shut them out and say, well, I got to worry about myself right now, you know, you build that loyalty and they'll reward you for it. One of the things that I think, Kevin, you touched on, actually a lot of you touched on, were this sort of idea of being nimble. And I started wondering, you know, especially in the US, there was a lot of discussion in the media on whether this industry, this sort of FinTech lending industry, because it's not, you know, deeply capitalized like a big bank, you know, smaller, that kind of thing, whether they can even ride out a downturn. And you know, we started thinking about it, and we were talking the other day about, I wonder if there's actually a way of flipping that narrative and saying there's actually an opportunity for this industry to play a key role in the recovery because you have that flexibility and that ability to be nimble. So I was wondering about your thoughts on that.
You know, I sort of wonder, is it an expectation that demand actually might go up? Because if traditional lenders do the typical response to recessionary expectation, and I've been a lender a long time, where it does get tight, and so does that mean opportunities for the alternative space, or does supply actually go away? Like, it's really difficult to understand what's going on, and just given my age and experience, I've probably gone through 4 or 5 different recessions, but I have not done it with a small private alternative lender. So it's a first for us, and I think there's clearly fragility across the board over the next number of years for our businesses. And I say that quite openly. It doesn't mean we can't do well through it, but I think it's there. I mean, we run on short-term fixed rates. I mean, we're not going to have a 1980s savings and loan crisis, but the reality is, to some extent, floating rate funding and fixed rate lending, but it's short-term stuff. So those aren't really problems. But I'll stop there and open up the floor.
Yeah, I would argue proudly that FinTech lenders are a key to keeping the ecosystem moving and going in times of a downturn and or coming out of a downturn. Our ability to react quickly where traditional banks, and this isn't a negative comment on traditional banks, they just move more slowly. I think that's just a fact. And having access to good data and ever-changing data and multiple data sources give us certain abilities to react more quickly. And again, saying it proudly, I think that we will continue to be, and will grow in terms of importance in keeping capital flowing during challenging times. Now, albeit it might be a little bit more expensive for the consumer or the merchant borrower, but again, it's a critical part of capital in the ecosystem, and that's a good thing, not a bad thing.
Yeah, I would agree. I'd say the caveat I would throw on that is, provided that sector can remain, or this sector of, let's call them relatively smaller compared to the banks, lenders, can remain reasonably well capitalized as we continue in the business cycle. I would agree, because I think what all three of our organizations share is, we're growth minded. We are very much at the leading edge of trying to pursue growth in the economy by helping those who either can or cannot get access to credit, depending on what spectrum you operate in. Provided we are reasonably well funded on our end, and that we keep that character, which includes being nimble and flexible, I would wholeheartedly agree. That's where I think we have a unique advantage that, as a former quote-unquote banker, I would say, yes, the mindset is different, because it is principally a risk-led mindset, and the mandate of the company, in the case of a large bank, is to protect the risk of the organization, which I respect. But when you're trying to, build an alternative business that's trying to incur into the sector and disrupt it in some cases, you have to be pushing forward in times of uncertainty. If I look at what our organization went through in Alberta in 2015 when oil crashed and unemployment doubled, we actually didn't significantly change our credit underlying structure. We were fortunate enough that a lot of our lenders on site saw that in the actual economy and adjusted their own behavior in response. We didn't have to all of a sudden, to Matt's point, jack our cutoffs, which if you're a traditional risk manager, the first thing that's going to do is actually increase your loss rates, because the denominator on the bottom is going to slow and the numerator on the top just gets bigger. So it's about finding that opportunistic point at which you can turn on those taps or maybe not shut them off entirely. And I think where lenders like ourselves have a bit of a different advantage is we're just more geared, and our DNA is more engineered to do that. Doesn't mean you can't do it as a bank. It's just a little harder to do. In our organizations, they're just a little bit more nimble. You're talking about 20 people, 30 people. You try doing that in a bank where you're employing 55,000 people, it's a little different, and it's going to take longer. So it's a bit of a unique aspect that I think relatively smaller lenders have, that we are able to sort of deliver that value add that some of the other players in the market just simply can't do.
Yeah, and I think folks that would be reminded of sort of the rise of FinTech in the U.S. was predicated by the 2008 crisis, right, where access to lending and access to credit really dried up as all the banks kind of went into a retreat mode, and it was basically the growth of FinTech in the U.S. And so there's clearly an opportunity in that market there, so there's no reason that couldn't replicate here. I want to talk a little bit, because a few of you mentioned it, about funding and capital. So as we get late into an economic cycle and even a potential downturn, the wholesale funding market can also tighten. So just discuss a bit how that affects your strategies, if at all, in terms of access to capital, and is there a component of capital liquidity that concerns you? And I don't, maybe you don't need to speak about your own business model, but as an industry.
Well, I can handle that. So OnDeck parent in the U.S. is a public company. It's available information and how that business is funded. The capital markets strategy is a very diversified one, multiple funding sources, staggered maturities. We benefit from that in Canada. And as a result of planning and being prepared and having a well-capitalized balance sheet, I think that gives you the ability and strength to go through downturns. So I guess the recommendation, going back to my comment with regard to flexibility at the outset, it's having a flexible, diversified, multiple-sourced funding strategy so that you can deal with those types of situations.
So I would wholeheartedly agree. We've just gone through that exercise ourselves. So diversified capital stack, staggered maturities, multiple funding sources. That's the sort of the BAU, business as usual requirement. We just recently added about $120 million to our secured revolving facility 3 weeks ago. Last week we called our bonds in the high yield market earlier and upsized them by another $75 million. What we would say is, when you expect the waters in the future to get a little choppy, buy a bigger boat, or insulate your boat so at least you can weather the storm a little bit more effectively. The downside of doing that is you're going to potentially take capital on your balance sheet and pay for it when you may not be able to use it as quickly. The upside is when that market dries up, or if it does a little bit of wonky stuff like we saw in some of those charts before, you're not as dependent on some of those volatility movements, which can wreak havoc on your income statement and your balance sheet. So as we as lenders, I'd say we have to think about it is, how do we prepare for a worst case scenario? Insulate, diversify, and again, part of that nimbleness I think that you had mentioned before is got to be ingrained in your culture, because if you can afford yourself the opportunity to focus on that, I can assure you, when other competitors are out there trying to figure out how they're going to fund their business, you can then figure out your time how you're going to grow your business, and that in and of itself is a very unique advantage that one can take advantage of.
Nothing really to add. Certainly one of our strengths has been our ability to attract good capital for funding, and to the point here, it's all about diversity. So maintaining at least a couple of separate lines with different maturity profiles is absolutely critical.
The only other comment I'd say is it's hard to do that. Like we talk about a diversified stack and staggered maturities and multiple funding sources. For those individuals in the audience who are in the financial funding side of our business, as a Canadian public company, it's very hard to do all of that, and it doesn't happen overnight. In fact, I would suggest to you it's probably one of the greatest barriers to entry, or more importantly, barriers to success in our market space as alternative lenders that we face. And the amount of effort, time, and patience you have to have in order to get to that level takes time. It took us almost 20 years before we could even access the US public debt markets, and that's despite 30 plus CAGRs in EPS growth for 20 years. It took us that long just to get money out of the States at what I'll call reasonable rates. So you can never do enough of that over time, and it's something that I would encourage any lender that's desiring scale in the long term. It is absolutely going to pay you back in spades, and it's going to pay you back in spades the most when times are bad, not when times are good.
Yeah, and I would add, I absolutely agree, Jason. I would add that it's about over time doing what you say you're going to do to those funding sources, being transparent, and having a very diversified book, right? So if you have a loan book that's diversified in industry and geography and across a whole bunch of different indicators, I think you can work with lenders who 5 years ago, 7 years ago, had this notion of, well, we don't lend to lenders, or, why would we be lending to somebody who's lending to borrowers that we wouldn't lend to directly? Things have changed. Again, as long as over time you demonstrate that you do what you say you're going to do. And if you build that trust over time, I think you can get to the place where you have multiple sources of funding.
When you think about where we are in the economic cycle, the reality is it actually, Jason, to your point, it probably is a significant barrier to the development of new firms coming into the space, because the risk that funders take is around the development of the portfolio and how big is it, how long is it, how diversified is it, and all that stuff that builds over time. If the relationships aren't established now going into the next few years, I could see it being particularly difficult to have the funding necessary to support what is a somewhat undetermined future for economic stability in Canada.
So I think it sounds like flexibility, nimble, growth mindset, diversification is the playbook, right?
It's probably protection for those of us that are in the space now from a competitive perspective, just because of the landscape.
Okay, I'm getting stared at by Gary, so I think we'll end it there. Neil, Jason, Kevin, thank you very much.
That was great. Great ending. Good conclusion.